We're continuing a series of videos about stock market to help you understand what is really behind the share price so you don't just simply follow the crowd and gamble with your hard-earned money. Now we all know that right now economy is not really good, but somehow stock market is holding up, especially in US. And a lot of people, including myself included, think that it's gonna come crashing hard because right now the stock market is artificially propped up by quantitative easing, aka printing funny money. This video is about zombie companies because it's one of the elements that can really contribute to a major stock market collapse. It happened in Japan in the 90s, so we're going to talk about what the companies are, what happened in Japan, how it contributed to the lost decade, why you should care about it, and we'll even look at companies like Uber and Netflix to see if those are zombie companies. Let's start with definition. So one definition is a zombie company is a company that can't operate without a bailout, and another one is the company that is in so much debt that they can still operate, but they can make only interest payments and not the principal ones to reduce it. In other words, imagine somebody that is living off credit card debt and they can make only the minimum payment. This can only last for a certain amount of time, and at some point that principal and interest is going to be so big that the person will go bankrupt. It is the same with companies. The company's goal and how to survive is by making money and maximizing shareholders' value. If the company is not making money for a long period of time, it's going to die at some point. So zombie companies are not dead yet because they're using debt to kind of stay alive, and hence the name zombie companies, because they're not dead, but they're not really alive either. This term was firstly used in relationship to what happened to Japanese economy in the 90s. So before the 90s, in the 80s, Japanese economy was growing at a really nice pace, which means that assets were appreciating in their value and everybody was trying to buy them because you couldn't lose. Every time you bought an asset, next day it costed more. That led to a speculation in assets and kind of this growing bubble of asset prices. To add to the issue of everybody trying to buy assets and FOMO, Bank of Japan held a very low interest rate so that that was cheap, and they had a very aggressive quota for their commercial banks. So that put a pressure on the banks to loan out the money, and usually when that happens, they stop looking at the quality of the borrower as much. It's pretty much the same thing that happened in the US in 2008 crisis. If you remember the classic supply and demand model, if the supply goes up, the price goes down. So when you have a crazy supply of cheap currency, the value of the currency goes down, aka inflation, the prices goes up. And that's exactly what happened in Japan. In an effort to curb that inflation, then the Bank of Japan decided to raise the interest rate. However, all it caused is the burst of that bubble, the asset bubble. The market started crashing really hard. Once the stock market crashed, all of those questionable loans became very problematic for the banks. Because when banks give out loans or mortgages, they actually write them down in the asset column of their balance sheet because they expect cash inflows. But of course, if the company cannot repay their debt, that becomes straight up liability. And if you have a lot of those, the banks can fail. And of course, the Bank of Japan bailed out the banks, and the banks played with revenue recognition principles to delay the bad news as long as possible. But in essence, those banks became zombie banks because their business model of lending money and getting it back with interest was not working without government bailouts. This created the environment that on one side you had a zombie banks that couldn't really operate without bailouts, and on this side we had zombie companies that couldn't really operate without the debt. And that caused major crash in the stock market. And the sad part about it is, if you look at it today, it still did not reach the same heights as in the end of the 80s. And it's a very sad part because if you ever heard about investing, they'll tell you that the stock market in the long term always goes up. But if you look at the Japanese stock market, if you would have bought a boring ETF, just like the whole Nikkei index, at that point and held it for 30 years, you would have still lost money. And really, it took Japanese economy around 10 years to recover, and that's why it was called a lost decade. Hindsight is 2020, and economists are known for being really good at explaining what happened in the past and why it happened. And there's a lot of lessons, a lot of articles about what caused the Japanese stock market crash and the lessons. But I think the number one lesson is what happened is because the money was so cheap for such a long period of time, when the crash happened and they tried to reduce the rates even more, they didn't matter anymore because that was not a determining factor. And I think this is applicable to today. And let's look at the US stock market because this kind of influenced the rest of the world and see if eerily similar conditions exist today. In US and actually in a lot of other countries, there are a lot of powers right now that are pushing money supply way up. Number one is quantitative easing, and part of it is that Federal Reserve, to keep the companies afloat, is buying debt obligation of publicly traded companies and actually private debt right now. They're buying debt of private equity. And in order to buy that debt, they're printing money, thus increasing the money supply. Another power that is influencing the liquidity and the supply of money is very cheap debt. The overnight rate, which is the rate that Federal Reserve uses to loan money to the commercial banks, it's almost at zero. It's 0.05%. This is why we have a perfect storm situation, because on one hand, Federal Reserve is pumping the economy with trillions of dollars by buying corporations' debt, artificially keeping them alive while increasing the money supply, devaluing the dollar. And on this side, we have companies and even individuals that have access to really cheap money through debt. Two of those factors are increasing the money supply and at the same time devaluing the dollar. And the only natural progression to that is inflation and the rise in zombie companies that can only survive through that cheap debt. By some estimates, the share of zombie companies in US economy can rise up to 20%. And the sad part about it is that the zombie companies are responsible for millions and millions of jobs. How does this affect you? Well, number one, if you want to have a better idea of what's going to happen with the market, you can track the news about the zombie companies and what share of the market they are, because looking at the points on S&P 500 from today to tomorrow doesn't really tell us anything. The markets are not that logical right now, they're not that efficient. But if you know that the share of the zombie companies is going up, you know exactly where the market is headed. The second way it affects you, if you have a savings program, say you have 401k or RSPs in Canada, and when you set it up, you said, I don't want to take a big level of risks, I'm just going to buy boring ETFs, I'm going to buy the whole market. Right now, it can be actually very dangerous because if you're buying the whole market, you might be buying up to 20% of zombie companies. So this is something to look at and perhaps adjust your portfolio. Finally, I want to go back to the video about how we value the companies, and I want you to be very clear on what's behind the stock price, not just simply follow the crowd. And I want you to be able to distinguish clearly between companies that are making money, bringing cash into the bank like Google's and Apple, versus the companies that are living through debt and perhaps one day they will make money, perhaps one day they will never make money. And if you look at the stock market right now, probably intuitively, you can identify zombie companies pretty clearly. Those will be the cruise ships, the airlines. Without the debt and without the bailouts, they just would not survive. They'll probably die. And perhaps after the crisis, new companies will be born. However, there are a few popular stocks with crazy valuations. One of them is like price to earnings is like 90, like Uber, Netflix. That in an essence, when we look at their financial, can potentially be a zombie companies. And again, instead of just buying the FANG stocks or Uber because you're using it, I want you to be able to look at financials and clearly see what's going on. So right now, I want to quickly look at Uber and Netflix. So firstly, let's look at Uber, and when you open their annual report, they have the nice stats. They're in 69 countries, 65 billion gross bookings, 7 billion trip, and they're using it as a really good information because the company managed to massively scale. However, I want to go back to this slide after we look at the financials. And the funny part about Uber, or not so funny, is usually the risk factors are like 5-10 pages. For Uber, it's 41 pages long. It actually took me like 2 minutes just to get to financial statements. So I finally got to the P&L, and right away I could see that for the last 3 years there is a negative amount in net income for operations, which means they're not making money from their general operations. And the loss in 2019 is very drastic, and this is because they invested 4.8 billion into R&D. But as an investor, one of the few questions you can ask yourself at this point is, if they have negative net income and negative operations, where did they get the money? And because we're evaluating zombie companies, the line you should be looking at is interest expense. And you can see just to cover their debt in 2019, they paid $559 million just in interest expense. And the kind of the sad part about it is, if you look at this whole column, and the negative loss, the net income is 8.5 billion. So even if they did not invest anything, like 4.8 billion was zero, this would still be negative $4.2 billion. So even if they didn't invest in R&D and just used all of those operations, they would still not be profitable. So that's kind of problematic. I then go to cash flow statements, and usually the first thing I really look at is what's going on with cash flow from operations, especially if the company is saying that they have net income profit. I want to make sure that the cash flows here mention it, but right away they're saying, well, we don't really have any profit. They'll add back the stock-based compensation, which is another worrisome factor for me. Because that means they're paying employees with their stock 4.5 billion worth of those salaries or compensation or incentives. What happens if the stock goes down and they have to switch for the cash? But not really concerned here, because they already said that they lost 8.5 billion, and when you add depreciation and stock-back compensation, it's still minus $4.3 billion. What I'm looking for, so investing is what money they invest in the R&D and the buildings, but I'm looking for financing activities, and that's basically how they got the money. And if the balance here is positive, that means they loaned more money, either in terms of stock issuance or bonds. And when you can see here that the amount here is positive, so that means they raised 3.8 billion amount of debt to get in their bank accounts to spend on that R&D and their operations, because the operations are not bringing in money. So that brings me back to this final slide, and looking at the valuation of the Uber right now. How much more do they need to grow from this massive scale to start making money? For me, it's a pretty big question, and I don't think there is a room to grow. I think they would need to either have another service, or they'll need to significantly increase their prices, which will make them less competitive. Now I'd like to look at Netflix, not just because we're all using it, but because the price to earning is 92. That means if they maintain the same level of net income as right now, it will take 92 years to break even. So let's look at their annual report and see if there's any justification to that. The good part is their risk factors is way shorter than for Uber, so that is good. And when we go to the profit and loss, you can see there is an operating income for last 3 years. So this looks good. They're making money. Because we're again talking about zombie companies, the interest expense is pretty high, $626 million, which grew from previous years. And when you look at this P&L, you can see they sold $20 billion in 2019. Then there is cost of revenues, marketing, technology, and general. So you would assume that whatever it costs them to license and produce the shows would go into this, because if you sold this much money and this is how much it costs you, that would be my assumption if it was the first time I'm looking at those statements. And of course, the next thing I'm looking at is the cash flows, because I want to make sure that the cash flows match the net income. And what's really apparent right away when you look at the cash flows from operations for the last 3 years, they're negative. So how is it possible that the net income is positive for 3 years, but there is no money in the bank? The money is just coming out of the bank. And the way it is possible, there is a big spending category right here, and it's additions to streaming content assets. And that's basically what they're investing into the production of the shows. And in my opinion, this should really be at the P&L statement on the cost of revenue. But they're saying this is kind of a one-time outflow, and then because the shows get renewed or they sell the merchandise, this is creation of their assets. So that's pretty questionable in my mind. I don't think they're a crazy manipulator, but if you look at the Benish manipulation score, there is actually 100% chance that they're manipulating their statements. I mean, it was not that hard to find it, so I don't think they're like actively manipulating it, but they are hiding the cost of the production, and technically they have net income, but if you look at it, they don't have net income. And going back to the cash flow statements, if the operations don't bring in the money, they only take it out, what does bring the money? And let's look at the financing activities, and you can see it's all positive. So if it's positive, that means that's the proceeds from issuance of debt. So just like Uber, with all of their sales, $20 billion in sales, and even though showing the net income, Netflix, by definition, is actually a zombie company because without that debt, they cannot survive. Certainly, emotionally, it's very hard to call Uber and Netflix a zombie company because we're all using them every day. However, when you look at their financials, by definition, they are. And perhaps at some point their business model and efficiencies can scale to a point where they can justify the current valuation. But for example, for me personally, those are not the companies I'm interested in because my risk aversion is not at that level. I'd rather invest in a company like Google that is growing and steadily bringing cash. It's maybe not as exciting, but in my opinion, it's more safe. At the end of the day, the choice is yours. You can take more risk and invest in growth companies. All I want you to do is do it knowingly. Thank you for watching. Until the next time.